Today, we're diving into an analysis that makes a really compelling asymmetric buy case for DataVault AI, DVLT, at about $1.83.
And the core idea is pretty straightforward.
Yeah, the price is just fundamentally disconnected from its confirmed $200 million revenue guidance for 2026. Let's get right into the feedback.
Sounds good.
Okay, so first up, the report relies heavily on external analyst consensus to define the upside potential. And this, it risks outsourcing the core valuation argument rather than truly owning it.
Right.
The material uses that consensus analyst price target was at $7.14 as the main measure of upside. And it notes that, 280% plus potential return.
Which is a great hook, don't get me wrong.
Of course, but by anchoring the fair value to that external opinion, it kind of diminishes the power of the internal metrics that you've already laid out so well.
You're talking about the 2.6x forward sales multiple.
Exactly. That 2.6x figure, based on the 200 million guidance, that's the real engine of the thesis, not the analyst target.
I see. So the problem is it kind of says, we think it's undervalued because Wall Street thinks it's undervalued.
Precisely. But the analysis already has the key insight. It has the confirmed guidance and that incredibly low implied valuation.
So the weakness is more in the presentation of the valuation mechanism than the data itself.
Yes. By leading with the $7.14 target, there's a little bit of a gap. Readers are left thinking, okay, but how does that 2.6x multiple actually translate into a target price that I can trust?
Right. One that's calculated independently of what the consensus is.
So the suggestion here, I think, is that the analysis should build a clearer, a bridge, if you will.
A bridge. I like that.
Yeah. Show us how the projected $200 million in revenue and that 2.6x multiple translate directly into a target price. This shifts the focus from what analysts think to what the intrinsic metrics prove.
It makes the argument much more self-contained, more robust.
So for a concrete example, you could explicitly just outline the steps. Calculate the implied market cap you get from a 2.6x multiple on $200 million in revenue.
And then divide by the current share count.
Right, and you get your per share value. If that number is, say, $7 or higher, you've just independently validated the consensus.
And if it's lower, say $5.50, then the report has to explain why the external optimism for $7.14 is justified.
Or another way to go, if you stick with using that $7.14 target, then you need to dedicate a small section to justifying why the multiple needed to get there is appropriate.
Because it's definitely not 2.6x to get to $7. It's got to be more like 5x or 6x.
Right. So the analysis should just state that. Say, this implies a 5x forward multiple, and here's why that's reasonable for a high-growth AI company compared to its peers. That transparency works either way.
That really shores up the valuation. Okay, but let's talk about the execution part of this, because that feels like the next big hurdle for any skeptic.
It is. So the massive jump from $2.9 million in Q3 2025 revenue to $200 million by 2026, that introduces just huge execution risk. The report touches on it, but doesn't really quantify it.
The analysis does highlight the 148% year-over-year Q3 growth. That's pretty strong evidence of traction.
It is a great data point, absolutely. But the scale of the acceleration required is it's staggering. You're going from roughly at $11.6 million annual run rate.
Based on that Q3 number.
To $200 million in about 6 quarters. That's an exponential curve, and the material doesn't give enough detail on the milestones or the deal velocity needed to actually pull that off.
But couldn't you argue the 148% growth already shows they can accelerate? Why do we need the granular detail if the trend is already there?
That's the nuance, right? The risk isn't that they won't grow. It's that they won't grow fast enough to hit a number that's 17 times their current run rate.
Okay, I see. It makes the $200 million target feel more aspirational than trajectory-based.
Exactly. Which is what the skeptics are going to jump all over. A ramp that steep needs a very specific plan for scaling up sales, for pipeline, for everything.
So to really bolster the credibility of that forecast, the analysis needs to bring in a high-level view of the execution mechanics, the engine that's actually going to drive that sales ramp.
Yeah. You need to detail the required scale-up in their core strategy, which is the Web3 data licensing.
Turn that $200 million number into actual sales targets.
Okay, so let's translate the money into a metric. The analysis could frame the target as a function of their RWA tokenization deals, real-world assets.
For instance,
You could say achieving 200 million implies the company must secure X number of new partners, each yielding an average of Y dollars in annual licensing fees.
that immediately makes it feel more concrete, more achievable, even if it's ambitious.
And that idea of velocity, it should be woven throughout. In the upcoming catalyst section, instead of just saying new licensing deals, get specific.
Something like specify the minimum size or frequency of deals they need each quarter to stay on track.
Yes. If they need to close one $10 million deal every 6 weeks starting next year, the report should suggest that specific velocity.
And the money. You have to connect the money.
Absolutely crucial. Connect that recent $150 million Silex investment directly to funding this expansion. It's not just, we have cash. It's, this capital infusion directly funds the sales and tech expansion needed to handle this exact deal volume.
Perfect. That changes the narrative from a maybe to a funded, metrics-driven plan.
Right. So let's move on to the third big opportunity here, which is around the technological defensibility. The analysis does a sharp job countering that Wolfpack short report, but there's room to go deeper.
On the tech itself?
On the tech. To fully counter the vaporware narrative from the short report, the analysis needs to go beyond just citing verifiable deals and offer a more robust defense of the underlying technology and the scalability of the Web3 model.
The report does a good job using the Silex and WBC deals to prove it's not vaporware, right? It shows they can actually sell?
It does. It addresses the sales credibility issue head-on. But the underlying mechanism, that Web3 data licensing, it's still pretty high level in the report.
Okay.
It doesn't fully explain why this model is so disruptive or defensible. And that leaves a gap for skeptics who might think, well, is this just a standard API with some buzzwords sprinkled on top?
That's the core question, isn't it? What does the Web3 structure actually deliver that traditional data licensing doesn't?
That's the moat. If the tech is hard to replicate, that's the competitive moat that justifies the high growth multiple you're implying with a $7 target.
So, since this is for investors, the report has to reassure the skeptic that the tech is proprietary. Does the Web3 part provide unique security or immutability or something that's a real value add over the old way of doing things?
And if it does, we need to hear about it. I think this can be integrated right into the growth section.
When you talk about triple-digit growth.
Explanation of what the Web3 strategy offers that traditional models can't, especially around the tokenization of real-world assets. The RWA piece is key.
And then tie that unique feature to a specific competitive edge. For example, with the Silex deal, explain how the technology specifically enhances the value of their pharmaceutical assets.
Exactly. Maybe it's about providing a secure, immutable data structure for their clinical trials, something that demonstrates real value beyond a standard vendor relationship.
You need to define that technical edge.
And finally, you should probably integrate a discussion on barriers to entry. What prevents a huge competitor, a major cloud provider, from just duplicating this once DataVault proves there's a market?
Are there patents? First mover advantage? Unique data techniques?
Anything like that. Explicitly addressing the tech's defensibility just completely invalidates the core of the short thesis and grounds the entire growth story in, well, technical reality.
That makes a lot of sense. It ties everything together.